Welcome, everyone. Really glad you're here tonight. I want to start by being honest with you. Most people come to a webinar like this expecting me to tell them to pay off their mortgage as fast as humanly possible. And look, getting out of debt feels good. It is good, but in over a decade of working with New Zealand families, the thing I've seen hold people back isn't debt, it's tunnel vision. Tonight, we're looking at three choices, same household, same income, same starting point, very different choices. And by the end, you'll see just how different their retirements look as a result. This isn't about which path is right. It's about making sure the path you're on is one you've actually chosen, not one you've just defaulted into. 45 minutes, no jargon, real numbers. Let's get into it. So you might be thinking, who am I to tell you what to do with your money? My name is Katie Wesney. I am the head coach at Enable Me. I am also a chartered accountant. I trained at KPMG many moons ago. I've built and sold my own successful business, and I am a columnist and media commentator. My job at Enable Me is to optimize outcomes for my clients and help them reach their financial potential. I will talk at pace tonight. There is so much to cover off. We'll be talking about the hidden cost of just sticking to your mortgage plan, why balance and diversification all really matter. And when we're talking about diversification, we're talking about KiwiSaver, investments, managed funds, property, how to decide the right mix for you and your financial future. So I'm just going to disclaim what I say tonight. This information is provided for informational purposes only. The content of this presentation is not intended as a substitute for regulated financial advice. I don't know your financial position, your goals, your hopes, your dreams, your obstacles. And if anything resonates with you tonight, I'll be sharing a special offer to come and see a coach like myself to do a deep dive in terms of your circumstances. If you want to ask me any questions, please do so. You've submitted amazing questions prior. I've got my lovely producer, Amelia, in the background. She'll be compiling those questions if you just use the chat box at the bottom of your screen, or it might be the top, who knows. Okay, so to be super targeted tonight, I'm going to pivot in terms of the audience. So we're going to be running a few polls. So first of all, I want to know whether you are mortgage free at the moment. Yes, I don't own my own home. No, I've got more than 15 years left. No, I've got less than 15 years, or I'm mortgage free on my home, but not on my investment properties. So if you could just take a second and just click on the option that resonates with you and your situation. Should have music. Okay, so mortgage free, yes, awesome. I don't know my home. Okay, great. No, I've got more than 15, less than 15. Okay, quite a spread. Vast majority of us, though, have a mortgage of some description. And if you don't own your own home, I'll still be speaking to what you should be doing in the background when you do have a mortgage, and hopefully how you can get yourself into your own home sooner rather than later. Okay, thank you so much. That's super useful. Right, so we had the OCR announcement today, which it held at 2.25%. All indications are, though, in terms of commentary, that likely we will see increases into the future. So again, we do not have a crystal ball, but all indications are we are nearish the bottom, and potentially we will see rate increases into the future. So what does that mean for people like ourselves who have mortgages? For my clients, the majority are looking to fix sooner rather than later, and they are using this opportunity as well to be really directive in terms of paying off that mortgage faster. That is the critical thing that makes OCR announcements less impactful into the future, because obviously a higher mortgage, a higher interest rate on a smaller mortgage is less impactful. So the vast majority of my clients are looking to fix longer term, unless of course they are selling in the near future, and they're keeping a chunk on floating equivalent to what they could conceptually pay off or offset in the next 12 months. And usually that's in a revolving credit. So again, really important to be tactical at the moment. Lots of people are really favouring certainty who I work with. And again, we don't have a crystal ball. We don't know exactly what's going to happen in the future, but also we want to be strategic in terms of paying that darn thing off. And the OCR certainly signals the outcome in terms of what we effectively pay, but there's lots of different things feeding into that in terms of what actually hits our loan statement. We have a oligopoly in New Zealand in terms of banks, and they tend to move together in terms of what we pay, and things fluctuate in terms of sometimes when certain offers are on, in terms of what we saw last year, where certain banks were offering very favourable cashbacks, and that again affects what is priced into the overarching loan book of a bank. So again, OCR important, it signals the direction of travel. It doesn't directly correlate to what you pay on an everyday basis. And the emphasis is please be strategic in how you address that mortgage. And in terms of that mortgage, I love that saying, they call it that death pledge. If you don't have a optimal mortgage strategy, it can be the reason why you get stuck in a job you don't like. You can't start the business you always dreamed of, or the thing that takes you away from spending time with your family. So please don't resign yourself to a life that doesn't feel like the one you've always wanted. In terms of you having a mortgage, there is a better way, and let's explore options available to you. And I'm trying to cover off really common questions I get asked from my clients over the last decade. So I'm going to introduce you to our model couple, Sarah and Mike. This couple situation is very typical of what we're seeing at the moment, with their names freshly minted on the title of their first home after an extended period of time saving up for a deposit. They're 35 years old, have a combined income of 200K before tax, and they're the proud owners of a mortgage totaling 600K being paid off over a 30-year term. They are proud of what they've achieved so far, but a little weary, uncertain of how they can possibly get ahead, and not sure if they will ever experience financial freedom before. So, first path for Sarah and Mike, if they follow the system that's been laid out for them, they have 30 years ahead of them on that hamster wheel, working so they can make their mortgage repayments. A sad fact that is little known is that your mortgage repayments remain the same until the day you pay the mortgage off. It's just the interest rate that can fluctuate. The mortgage isn't paid off until that last bitter repayment. And disappointingly, this couple will also pay around double the value of their mortgage, some $1.2 million. That is what the average Kiwi is doing. We are buying our first home at 35, and it's taking us 30 years to pay off that mortgage. So they're investing into KiwiSaver, and they're just matching their employer contribution. 3% at the moment, and they've got no other investments, and they're doing what the vast majority of us do, is they're spending everything that they earn. So Sarah and Mike, default traditional path. This is what the average New Zealander is doing and what they are inevitably signed up for. But there is another way. The second outcome we're going to cover off tonight is the option of pulling back on spending by 15% and finding some extra money to invest elsewhere. And that 15% is very deliberate. We have been around at Enable Me for a very long time. We started at the time of the GFC. So we've seen lots of economic cycles and walked alongside our clients. What we know to be true is on average, we fritter about 15% of our net income. A little bit of overspending, a lot of paying too much interest to the banks. And we have super profitable banks in New Zealand, some of the most profitable in the world in terms of interest rates and fees. That 15% is a really important number. What I do every day is find that money that's going walkabout and put it to better use in terms of strategy. How you do that is you're intentional, you know what's coming in, what's coming out, you have a really good structure around that, and you have a clear goal. In this example, they are making the minimum repayments on their mortgage, same interest rate, same mortgage repayment, but they're finding that 15% of their take-home pay by being intentional in terms of structure, and they're investing it in managed funds. What could Michael and Sarah achieve working with Enable Me? So the third, and we would argue the most superior option, is to take the approach of the mortgage master. This approach combines being strategic around how you structure and pay off your mortgage, as well as using the power of leverage to grow wealth sooner. Financial freedom for this third path will come much sooner than the previous two. So why wouldn't you? A coach can walk alongside you to work out your own unique personality type so you get the best results. Success is 80% behavior, 20% systems. And in terms of that base position, if still bought that same house, same time, they've got that same mortgage, but we're pushing them to not only find that 15% that's going walkabout, but we're trying to get to that 20% that's going walkabout with a bit of intentionality on the end to channel that into paying off their mortgage faster. And remember, when I talked about the OCR and what we're seeing now is that there is signaling that interest rates will go up or the OCR will increase into the future. So when we're talking to clients at the moment, we're thinking that, well, certainty is important. We want to pay the least amount of interest to the bank, certainly. So we're kind of trying to get a balance of fixing for certainty, but still leaving a piece that we can attack in terms of strategy. And in this example, what that would look like is that 20% number that we're aiming for in terms of surplus funds that would sit in a revolving credit owing to the bank. And as they have surplus funds, they plonk that into the revolving credit. It offsets debt, but they can still re-access it. And that's a really nice feature of that revolving credit. And by doing that, finding that 20%, they improve their mortgage trajectory to 12 years. So they're mortgage free at 47. In 5 years, at age 40, they will have built up enough equity in their property to buy an 800K investment property. Because remember, I said when you are executing on a holistic plan and you are trying to move all the levers at the same time, you can't just do one thing. The goal isn't ever to just pay off one property because you can't eat your house. That certainly is an achievement, but what else should you be doing overall? And for lots of our clients, they don't necessarily have copious amounts in the bank that they can invest, but they do have equity in their home that they could potentially tap into to buy a second appreciating asset that goes up in value in time. So, what does that look like from a maths perspective? So, I'm going to talk in round numbers just to keep things really simple. And Any dreams about spending more time on hobbies or with grandchildren had to be put on hold at this point in terms of 65. The only money in the retirement pot is from KiwiSaver, and we know that the average New Zealand couple will need about 900,000 plus extras. In terms of this example, they have, and this is doing the default, spending everything that they earn and being mortgage free on one home, investing in KiwiSaver at the rate at which their employer will match. And this is not to be sniffed at. This is giving you options and understanding consequences, because that's really important in terms of strategy, that you own your own strategy and what speaks to you. So following the traditional path, Mike and Sarah, they have a mortgage-free home, which is an achievement. They have 591,000 in KiwiSaver, which again feels like a sizable amount, but they have no further time to build any other wealth before retirement because their surplus was channeled into just paying off the mortgage and they were spending. So again, not nothing. That is the base position in terms of mortgage-free home and investing in KiwiSaver. So let's have a look at the second pathway with the option of finding that 15% of cash flow inefficiency and putting that in a diversified investment fund, a managed fund, effectively. For purposes of this illustration, we've compounded their 15% annual contribution by 3.5%. So what you see takes into account inflation, fees, tax. Essentially, it's in today's money. Then we let compound interest work its magic. Not too bad, to be honest. This is a retirement with a few more choices. So again, in this example, mortgage-free home, awesome. They've got that same 591,000 in KiwiSaver, applying the 3% and the 3% in terms of employer contribution. And on top of that, in terms of being intentional, having money left over, investing it wisely in managed funds, that equates to 1.91 million. So again, lots more options in terms of that behavioral piece around having a surplus and investing it really wisely. And again, you might say, well, I'd be happy with that. But it enabled me, you never work with a coach because you want to be fine. You work with a coach because for most people, they're ambitious and they want to make the most of their position. And so for a typical client, that we've worked with, this would be the end result in terms of strategy. So paid off their mortgage at 47 means that they've had 18 years to grow their wealth. That is a longer runway in terms of compounding returns. With that runway, we managed to invest that 71K per annum into investment funds, and they've also bought a property along the way. And so again, what that equates to is they have that same mortgage-free home. They have 591,000 in KiwiSaver. They've got 921,000 in investment property gains. So they have paid off their mortgage to a point that they had enough equity to tap into that, to have another appreciating asset before retirement, but also in enabling them to get mortgage free faster. That meant there were funds left over that they could further invest. Because again, they have more money left over because they're not paying that mortgage, which soaks up the lion's share of lots of cash flow. And so then, in terms of investments, they've got a further 1.77 million in managed funds. Quite the difference. What you're actually doing is tapping into the magic finance fundamentals, compound interest and leverage. That is the wonder of personal finance, and you are saving thousands of dollars of interest that you would otherwise have to pay back to the bank by getting mortgage free faster. And you're letting leverage do its thing over the years while we work on diversifying investments even further once mortgage free. And when I look at that position, That is freedom for my clients. That is the ability to help children. That is the ability to not work. That is the ability to travel and not worry about all of this. And again, does it just happen? No, because otherwise everyone would else be doing it. You have to be deliberate. You have to buy the right property for you from a numeric perspective, and you have to be open to opportunities. There are blips along the way, of course there are. With my clients, oh, I've just seen everything in the last decade. COVID, not a vibe. Lots of my clients got made redundant in periods and waves. We've seen property prices decrease. We've seen interest rates in the sevens. It has been a rocky road, but it is always rocky. You don't have ultimate certainty, but when you can act, you should. And there is never a perfect time, but there are fundamentals in all of this, leverage and compound interest, that make all the difference to your personal situation when you know how to lean into it at the right time. And again, just underpinning that in terms of the differences around interest paid back to the bank. um, so again, interest paid as a mortgage master, that's 223,000 of interest you pay back to the bank, being mortgage free over that shorter period versus 660K with the traditional path. And remember, that's the average that everyone else is doing. In terms of comparing net investment wealth, over and above having a mortgage-free home, the numbers really don't lie. Traditional path, 30 years, mortgage-free, KiwiSaver ticking along, 591K invested wealth at 65. Second option, finding that 15% inefficiency, and that is my bread and butter in terms of that behavioral piece that overlies strategy. Invest that surplus into managed funds. Again, not to be sniffed at. That gives you an outcome of invested wealth of 1.782 million at retirement. But for us, it's the synergy of all of those things together. And I reiterate this to clients when they come. My job is to ensure that you have an optimal debt reduction strategy, and we're looking at appropriate ways to grow wealth across property and funds. I actually could care less. It's just what would serve you best in the context of your plan and your goals. A lot of these things aren't available to everyone. It's age and stage in terms of where you can lean. And so, again, using that same 15% to kill debt faster and leverage into property, 3.289 million, same income, same starting point. The only difference is strategy. So, why does this matter? Well, again, it just means that you live your life on your terms. You can have a happy retirement, you have choice around the work you do, how long you work for. And I suppose the biggest thing for lots of my clients, it is just having peace of mind. They just don't have to worry about money going forward. And and again, which scenario reflects yours the most at the moment? The traditional path, investing with that cash surplus. Are you looking to be mortgage free faster? Invest in property and funds. None, I don't have a mortgage. None, I'm retired, having paid my mortgage off. Hopefully, I've got clients listening, so they're mortgage masters. Cool, I do. Awesome. And again, for there is no judgment in any of this. Vast majority of us here on this call are on that traditional path. Good to know you have options. I swear to you, having options though is not enough. You have to take different actions, and then your whole trajectory will shift. It is possible, but you've got to change things up from a strategy perspective. And again, investing with the cash surplus, that is wonderful. But what else are we leaving on the table in terms of strategy? No, I don't have a mortgage. That is awesome. What else should you be doing? I saw some lovely clients yesterday who'd worked incredibly hard. They had a mortgage-free property, they had some investment properties, and then they had a whole lot sat in cash and term deposits. And I understand the need for being safe. It's a non-negotiable for my clients that they have a good buffer, but the option of having a disproportionate amount in cash or term deposit, there is a cost to that, in that likely the return on those cash or cash equivalents aren't keeping up with inflation. So by being safe, you're effectively banking a loss. So again, it's how do you get comfort in all the different strategies that you should be doing, that you're on track and you're going to be okay going forward, and how do you ensure that you have the confidence to act at the right time? What I'm telling you is there are fundamentals in terms of strategies that don't shift, no matter what the OCR is doing or the interest rates that you pay. And I hope that gives you back that sense of control and autonomy, because there is lots of things you can't control. The OCR is one of them, but you can control how you operate around money on an everyday basis. You can control how you structure debt, and you can control what you invest in. That is within your control. Someone's sitting in the shade today because someone planted a tree a long time ago. And I really love that saying. And often people come in and they're like, "Ugh." My most common piece of feedback after a year of working with us is that they're really excited about what they've achieved. But there's always that sense of, that's a year ago, 5 years ago, 10 years ago. But I really do believe you come to it when you're ready, and you can't change what's happened. All you can affect is what you do into the future. So, what's the solution for you? You can't just do what you've always done and expect different results. Just none of this works like that. If you want to be different from everyone else, you need to do something different. And the solution often comes from doing the right mix of things for you. And there are lots of different ways to invest. And I'm really interested to know what you currently invest in. So there is, no, I'm not sure if this is a poll, Amelia. Yes, it is a poll. Never have too many polls. What do you currently invest in? KiwiSaver, Hope So, investment property, shares, managed funds, term deposits, high interest savings, or not at all? Again, lots of different options. Nothing's wrong or right. It's where do you lean in terms of age and stage, and what are the options available to you? Oh, hurrah, 95% in KiwiSaver. Great, you're not missing out on free money if you're employed. Awesome. 25% in investment property. Love that. Shares. Hmm. Interesting. Shares, it's really interesting. It's kind of the default position of lots of people that I see in terms of very traditional kind of share picking. I'm never as enamored with that structure and strategy for the vast majority, because I think it comes with risk in terms of investing in individual companies. So you're investing in their board and that particularly geographic region, etc. And my preference for my clients when they are looking at investing in equities, that they spread their risk in terms of managed funds. And again, it's just depending on what kind of fund type that you want in terms of risk. That is my preference. Good old term deposits, always a stalwart. Again, it's just where you are from an age and stage, not wrong. You just got to understand, could that money be working harder for you? Again, if it's a buffer, important. But again, if you have debt In savings, preferences it is offset on the proviso that you can re-access it. So it's just how all the componentry fits into that broader plan of yours and your goals, because your goals will be different to my goals and my clients' goals, who I've seen over the last decade. And again, you want to ensure that your strategy is fit for purpose for you and your family. So I'm going to cover off a question that often, when I go through this presentation, and I've done this presentation once before, and it's a really common question that I get from clients who come to see me initially. And I'm going to cover this off because it annoys me. Is residential property still a valid investment in New Zealand? Yes, it is. Yes, it is. Why? It's not that property gives you exponential gains. It really doesn't. The beauty around property is leverage. You put in your money, the bank puts in their money, and you keep 100% of that gain. Historically, that has outperformed other asset classes over time because you've got a bigger asset that's appreciating, got a 30-year track record. It is cyclical, but the economy is cyclical. And if you're as old as me or older, you know that. You've seen the cycle. Someone else is paying your mortgage. It's a natural hedge for inflation. That is really important. And you've got more levers than any other asset. You can add value, restructure debt, refinance, rent goes up with inflation. So again, for lots of my clients, having an element of property within their investment strategy is important because it helps with volatility. And again, I'm not saying that's the only thing you do, but it's certainly an important aspect for lots of clients. And the question is never just, should I invest in property? The question is whether this property at this price with this structure is right for you. And property is never a lock and leave strategy. You're always assessing, is it fit for purpose and will it fit my plan through that next asset cycle? So that's really important. That old adage, you never sell a property, I totally disagree with, and for most of my clients. And make a long-term financial plan that includes the right mix of investments for you. I really encourage you not to settle on a single approach. In fact, many people, most of my clients, choose a mix of investment options. Diversification is the mix of different investments, and that is what helps reduce risk. And again, it's where do you lean age and stage and what is available to you, and where do you need to get to in terms of retirement. And again, we all have the same options. The spread there, the right option depends on the problem you're looking to solve and your time frame. And so often with my clients, we sit down and we understand, well, what does a good life look like to you? What does it cost you? Because in effect, we need to be growing your assets to a point that feeds that when you're no longer working. Everyone has a different number. We understand yours and we execute on a strategy around that. And we don't put all of our eggs in one basket because that never bodes well. And again, just reiterating again, the best approach for you depends on time frame, so how long you have for retirement, your different goals, your risk appetite, capacity for risk, and the client who had that disproportionate amount in term deposits and cash equivalents. She was really frightened by risk, and I absolutely hear and accept that, but understand the goal and where you need to get to, and understand what else you should be doing to mitigate that risk of having that disproportionate amount set in savings or assets that aren't keeping up with inflation. That's really important. And you must allow flexibility. You cannot have a plan that's set in stone, otherwise, it becomes irrelevant to you. That is super important. Always have a buffer. The ability to access mortgage lending. Lots of people come with this tunnel vision. I just want to get mortgage free, Katie. I just want to get mortgage free. I'll think about all this investing after that. I just want to get mortgage free. but often that singularity in terms of goal, and I love being mortgage free, that is a really important goal for my clients. But sometimes, if you are just focusing on that one path, you accidentally heap more risk into your position because you miss out on having another appreciating asset and your time frame to retirement is shorter, so likely you need to bank more of a gain in terms of returns. So again, that access isn't infinite. The older you get, the harder it is to access lending. That's just a fact. And everyone has different wealth goals. But with any investment plan, time in the market is far better than timing the market. There is never a perfect time to start or do any of this. The right time is now, and you ensure that you have the best hold strategy available to you and have the ability to pivot as needed. So often people ask us, well, what does an enable me coach like myself do? We are able to zoom out from an independent perspective and identify your capacity likely better than you can with independent eyes. We've seen it all before. We create options for paying down that mortgage faster, and it's about being really deliberate and structured. I could care less what bank you're with. It's not the bank that you're with that makes this work. It's having a really good strategy. Of course, I know strategy and structure. Of course, I do. But I think a big component of my client success is that external accountability. You always do better when you work with somebody else. You lift your game, you do what needs to be done, and you get there in the shortest amount of time. That does play into my clients' success. And you have to be establishing a wealth plan alongside any debt reduction plan. And that's about assessing the options, understanding your opportunities and opportunity cost. And again, knowing all of this, and I think often you're here today, which I really admire, but in terms of today, there is an excess of information available to us through the internet, podcasts, webinars like this. We do not have a deficit of information. It is understanding and catching what's relevant for you and taking action. Knowing all of this means nothing unless you take action. And often you need confidence to do that, and you've got to do it at the right time. And so that's embedding that ongoing relationship often. And I need to be clear to you, there is a cost to doing nothing. Often we think, oh, well, this sounds all confusing and hard, and I don't know what to do. I'll just be safe and do nothing. That is generally the biggest cost to you. And often people are like, oh, is now the right time to start? Should I wait until interest rates are optimal? Define optimal. Um, can I figure this stuff out myself? Maybe, but it might take you a long time. And again, there's an opportunity cost to length of time. And should I wait until the economic turbulence dies down? Well, good luck for that. Because there's nothing I know to be true, that there's always some kind of happening in the world, elections, Trump, wars, flooding. There is always something else going on. All of that is in the I can't control. All that I've talked about today is in actions and controllables. Don't let that be the excuse for doing nothing and holding yourself back. And that gap, remember, between path one, the traditional path, and path three, to be clear, is $2.7 million. That was not about earning more. That's not about timing a market. That's about decision making. Most people are on path one by default, not by choice. I really encourage you to ignore the noise and be strategic. The OCR, the headlines, the rate speculation, none of it moves the dial like your structure does. And get the right mechanisms in place and let time do the heavy lifting. So, in terms of wanting to know exactly where you sit today, I'd really encourage you to get clarity on your starting point and the consequence of the path you're on and other options available to you. We offer 60 to 90-minute initial consults with coaches like myself up and down the country, face to face or via video, we don't care, who are able to show you exactly which path you're on and what's available to you. It's like jumping on the financial scales. Where are you at now? Where do you want to be? And are you on track? I promise you there's no jargon, there's no obligation, just your numbers, your options, your decision. So we've got a wee offer tonight. If you would like to come to a consult with a coach like myself, 60 to 90 minutes, we've discounted that down to $100. You've got to book tonight, though. Booking is made after this date. You'll secure the consult for $149. So that's the offer for tonight. You just scan the QR code or you go to enable.me/mortgage mastery. So that is us. We've got a truckload of questions to get through. Amelia, hit us.
All right, thank you to everyone who submitted their questions. The first question we have, I would like to know what the meaning of OCR is and how these
Such a good question.
announcements affect my mortgage.
Great question. So the official cash rate is the interest rate the Reserve Bank charges banks to borrow money overnight. When it moves, banks may adjust their mortgage rates, but they also factor in competition, profit margins, and funding costs. It's an influence, it is not a direct link. So keep that at the back of your mind, but it does signal the general direction.
All right, the second question is a lot bit longer one. I'm planning to direct my money from my investments and savings to my first home deposit. What are the next steps to consider when rebuilding savings, rainy day funds, and investments while paying off a mortgage?
That is a big question. And well done. Congratulations. I think it's really important for any wealth strategy to have a property component. Doesn't necessarily have to be your family home. For lots of my clients, it's actually an investment property and they continue to rent, but well done. And initially, for my clients who have initially bought, if there are any surplus funds over and above that minimum deposit that they need, the 20%, then I strongly encourage them to put that against the mortgage as a buffer. So it offsets debt on the proviso that you can reaccess it. So think about that in terms of that initial structure. And on top of that, and that generally is that revolving credit we've spoken about. And generally speaking, I want you to drive that mortgage down faster than that traditional path. So generally speaking, I'd really encourage you to think about, well, if I paid the minimum amount and I covered all my costs and I kind of lived a good life, is there money left over? Make that the target, pop that in the revolving credit plus any buffer that you have. And that is the way you drive down that mortgage to give you more capacity to invest thereafter, but doing it in a way whereby you offset debt immediately, you pay less interest, but you can reaccess it. That's the key. I'm not necessarily a fan of having savings off to the side when you have a mortgage. Doesn't really make sense to me because you always pay more interest in debt than you receive in savings, and then you pay tax for the privilege of earning less on those savings. So you've got to be really tactical in terms of that mortgage structure. So that is what I would be encouraging you to do so. And don't forget to make sure that you look at your KiwiSaver settings as well. Want you to be matching what your employer is doing if you are employed. Obviously, that's not individualized financial advice. And I want to make sure that you are in the right fund type for you, because likely when you were looking to buy that house, you might have changed the risk settings. If you have 10 more years left to retirement, which likely you have in terms of buying your first home, make sure that you're in a growth fund to maximize your returns over that time. So there's all of the things that I would like you to be considering in terms of ordering and your plan.
Right. The next question, you speak to this a bit already, but is it best to fully pay off your mortgage or leave some money in the bank?
Is it best to fully pay off your mortgage? Obviously, it always depends. the general rule for my clients is you wouldn't just focus on a singular strategy to pay off debt. Why is that? Because there is an opportunity cost that that equity sits there doing nothing, of which you could tap into to have another appreciating asset through that asset cycle. So likely when you do have capacity to invest, you should, because there's a timing element in terms of that's not open to you infinitely and it's just giving you more choice in terms of savings. If you have debt, again, you just offset it likely in terms of your plan on the proviso that you can re-access it. So that is generally the answer, but obviously it depends in terms of someone's plan.
If the bank limits us to only being able to pay back 30,000 extra per year, how can we then pay this off even quicker if we have additional funds?
That's a good question. So, generally speaking, the banks will allow you to repay a fixed amount up to a point, or you might have 30K floating. I'm presuming you've got 30K floating and the rest is fixed. You can always chip off a piece of your mortgage at any point in time. There could be a break cost associated with that. But again, in my mind, if you could pay off that chunk and you were paying zero, likely that would outweigh what you would have to pay in break cost. So those are the numbers I'd like you to be thinking of. And generally speaking, for my clients, so say if they've got a, let's use an example, they have working really hard, their company's been doing well, yay, in this environment, and they've got a 50K bonus. Generally speaking, we would say, well, let's chip off 50K of a fixed term, pop that in a revolving credit, plonk that money against the mortgage and they can re-access. So that's again giving them a safety net thereafter. But we'd always check the break cost in terms of that the benefit outweighs the cost. These are the things you need to be thinking about.
Another weird question that we get quite often, and someone asked this a few times in this webinar as well, what percentage of my mortgage should I have paid off before investing?
Such a good question. And it's generally not a percentage. It's generally that you have the capacity within that mortgage to have a deposit on something else. Generally, that's what you're looking for in terms of numbering, and that your surplus funds are such that you could sustain having to top it up essentially. So that's generally what we're looking at in terms of specifics. Such a good question.
I think let's make this our last question. There are some people who asked in the chat, what are the benefits of KiwiSaver? Some people have already answered them, but do you want to speak a bit more to this? Since,
Yeah,
yeah.
I really love KiwiSaver as a product. I think it has meant that we have saved more as a nation for lots of us than we would otherwise. Why is that? Because it's automatic. And to me, the benefit of KiwiSaver is that it's automatic, it happens before we see it, but that the employer will match it. That is free money. I love free money. So again, I think the true benefit is it's automated, it's locked for retirement, and that you get that matching. That is awesome in terms of compounding returns. My plea to you, though, is to ensure that you're in the right fund for you and you're getting the returns that you deserve. So you've really got to make sure that, again, it's an appropriate risk setting. It always kind of breaks my heart when people come and they're like 45, they've bought their own house and they're in a conservative fund. That does not make sense to me because that's cash or cash equivalent. Cost to you of being safe is that you're not getting the returns and you can't access that thing until 65. That is a long road to home, my friends. You want to be maximizing those returns because you can see out the ebbs and the flows. So I think KiwiSaver is really important. I love the automation around it. I caveat that with my clients, we automate a lot of things embedded within their structure and their plan, but make sure that you're in the right fund And again, you're getting the returns that you deserve. That's really important that you want to be reviewing that.
All right. Thank you everyone for joining us tonight. If you have any other questions about what we do, please feel free to give us a call or email us tomorrow. Katie, I'll let you close off.
Great. So thank you for your attendance tonight. I hope you got a lot out of it. And I really encourage you to take action into the future and think about your controllables because you can affect change and you likely have more control than you think, but you got to take good action. And that's what I want you to encourage you to do. Okay, all the very best. Take care.